You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call around here, the old Options Insider Radio Network. Hopefully you guys have been glued to the network of late because there's a plethora, a legion, a myriad of content hitting the network these days from the big options industry conference down there in Miami. I was down there all week recording a bunch of sessions. We also, of course, grabbed all of the panel audio just for you guys, so exclusively for our listeners and our audience. So if you couldn't make it to Miami or you didn't feel like shelling out whatever the fee was, $1,000 or more to register for the conference, plus hotel and all that fun stuff, don't worry. We've got you covered. Surf on over to our site, click on the Insider Radio Network tab, or just search for our shows, Options Insider Radio Network, in iTunes, Stitcher, wherever you find your favorite podcast programs, or indeed grab our mobile app. It's all available there for you as well. And then sit back, take that $1,000, put it to use somewhere else, and listen to all the great content that you missed. It's going to be unspooling. It's already started coming out this week. There's more to come over the coming week as well, so stay tuned for that. A lot of great content for you guys to catch up on coming out of OIC. And joining me on the old program today is, of course, my volatility compatriot, the yin to my yang, the Greasy Meatball himself, Mr. Mark Sebastian from OptionPit.com. Mr. Greasy Meatball, welcome back to the Volatility Views program, sir.
It's great to be on a show where I've got a co-host. And in fact, it's even better to get the whole band back together. We're getting the band back together, dude.
Yeah, what you're referring to is indeed, I know you're excited. I can hear it in your voice, and I am indeed very excited as well. He and I were just emailing back and forth about some other things, and I thought, hey, why don't you come back on the program? It'd be great to have you on. I know we routinely get emails and tweets from people asking, hey, what's going on with Don? What are those guys up to over there at VolX? Can you get them back on the program? Can you ask them this for me? Can you do this for me? So, Don, you guys have clearly not been forgotten. Of course, if you're new to the Volatility Views program, the guy, Don and Bob and the partners over there at VolX were our big supporters of this program for many years, over 2 years, and a lot of cool stuff was cooking over there at VolX. Well, they are back with a lot of cool stuff. And, of course, back on the old program, Mr. Sold to you himself, Mr. Don Schlesinger. Don, welcome back to the program. It has been too long, sir.
Well, it's really great to be back, and as Mark said, a reunion of sorts. For a long time when 2 p.m. Eastern time would roll around on a Friday afternoon when we're taping this, I was lost, not knowing what to do. So here we are back together. I hope we'll have some fun.
Yeah, I'm trying to think. How long has it been? It's been over a year since you've been on the program.
I think it might be 2 years, but I think it was around this time, maybe 2 years ago.
Wow. Time does indeed fly, sir. So some of our longer listening listeners will certainly be familiar with your program. And if you did miss those episodes, again, I encourage you head on over to our site or to iTunes, wherever, search for Volatility Views. Look at the archives because, there's a lot of timely stuff in there, but there's also just a lot of great guests. We brought on so many great guests on this program, Nobel laureates in volatility, great researchers, great traders, great practitioners. So if you missed any of those, I go back and check those out because those are timeless, those are evergreen, and you could certainly learn a lot from those guys, even several years down the road. I know looking at the numbers, I know a lot of you guys like to do that. So head on over, check out the archives, check out the greatest hits of Mr. Don Schlesinger. But Don, before we dive into the show proper, you have certainly, for a guy who's ostensibly retired, have been quite busy. Did I just see recently you got inducted into the Blackjack Hall of Fame? Is that correct, sir?
Yes, I did. That's something that's an annual event out in Las Vegas. Anybody who's interested can just Google Blackjack Hall of Fame. But I guess it was my turn this year, and there was a big bash out in Las Vegas in January, and I guess I'm proud to say I'm the latest inductee into the Blackjack Hall of Fame.
Well, there you go, sir. Listeners may not know, but Don dabbles in many other things, including blackjack. In fact, I've been joking with him for many years now. We need to do a blackjack show on the program, on the network. I think that would be pretty fun. So maybe one day we can squeeze your arm into doing that.
By the way, Mark, I just checked our website where we archive all of the Volatility View shows that we did, and I wasn't far off. I've got like our 90th show that we did together, and it's dated June the 3rd of 2013, so coming up on 2 years.
There you go. So it's almost an anniversary. Perfect timing to get you back on the show, Don. Without further ado, let's dive right on into it. It's time for the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is, of course, the portion of the program where we break down the week that was from a volatility trading and analysis perspective. A lot of things to sink our teeth into this week, including some mega trades out there in the options land and a few other places. But before we do that, Don, since you are our returning guest after 2 years, I shall yield the floor to you, sir, give you pride of place. What's been catching your eye over the past week and indeed perhaps even over the past 2 years since you've been on from a volatility perspective?
Yeah, I'm going to do the very quick 2-year synopsis. But I will tell you this, and this is kind of funny, and that is that I'm sure both you and Mark Sebastian remember that a couple of years ago when volatility was somewhat in the doldrums and people were talking about 10, 11 realized volatility, 12, 13 VIX, and saying, oh, how low this is, because, they were comparing it with previous years of 16, 18, 20 or so, and we kept on saying, you know what, this could stay like this for a very long time. This could be the new norm. And, if you think that it's normal to just have 20 and 22 all the time, you might have to get used to this. So, I look up here on our VolX website, and I look at realized volatility, and it doesn't matter whether your time frame is the last month at 10.96 or the last 3 months at 10.84 or the last year at 11.64. Actual or historical market volatility has been at those, what a lot of people would say, rather low levels. But, I guess I'm saying the same thing that I did 2 years ago. Maybe you have to get used to this because it seems that we've seen a lot more of these levels than we have of the 16s, 18s, and 20s that used to be commonplace.
Yeah, it seems like when a few months back, when the VIX Cash first started drifting down towards that 14 handle or so, we started seeing this persistent drumbeat in the media. A lot of it coming out of the CBOE and other places that, hey, this is a mean reverting asset. This is going to revert, and the long-term average of the VIX is somewhere around 20, so it's got to revert. So get back in now before you miss the big reversion to the upside. And we've seen a few blips in that period, but you're right, Don. For the most part, it has been kind of this long, slow, steady progression to the downside. And you're right, we kind of have been saying this on the program for some time. People who perhaps lack that longer term frame of reference with volatility may be lured into that trap of, hey, I have to come in. I got to get some of this VIX before it reverts back to 20 or 25 or who knows, higher, or whatever their thought process is. And if they haven't been around for a while, they haven't seen, S&P vol hovering in the single digits sometimes, and certainly in the low teens for extended periods. They may not be used to this. They may not think this is an aberration when in fact the higher levels are actually perhaps the aberration. Mr. Sebastian, we turn now to you, sir. A lot's been cooking in the land of vol since we last chatted. What's been catching your eye out there, sir?
I wrote you'll like this story. I wrote a blog about VXTYN, which is the VIX of the 10-year note. And I got an email from somebody saying, hey, we'd like to promote this. Can you just make a couple of small changes to improve the accuracy of the story? And I said, absolutely. I want it to be right. And then I put the changes. It got a little promoted. And then I found out 2 weeks ago, did you know they changed the symbol?
Yeah, I was going to say, I was just trying to pull it up now, and it's not coming up.
No, it's now called TYVIX. I had no idea.
There we go. That would explain it.
So the funny part is the guy gave me all these changes, didn't have me change the symbol, because that's how obscure the symbol change was. But I don't just tell that story for the humor of it, because it's obviously hilarious. But really, I think bond vol has been where the vol has been. If you've been looked in, over the last few months, there has been volatility. There's been volatility in oil. There's been volatility in gold. There's been volatility in currency. Now we're starting to see some real at least relative to how it's been the last few years, we're starting to see some real volatility in the interest rate market and the credit market. And a lot of people may not know this, but the credit market is 80, 90, 100,000 times bigger than the equity market. And if that starts rocking and rolling, that could be interesting. But, a brief look at the last couple of weeks of how the 10-year note has traded and how, some of the ETFs around it like TLT or IEF have traded, I think give us a real idea of really how much the bond market has started to kind of move around over the last few weeks. And that's really what I think is long-term in terms of volatility. That I think the credit market is going to be the dog that wags, is going to be the dog to the equity market's volatility tail. And so if the dog decides to calm down, then I do think the equity markets could continue this long, arduous journey of 12 VIX. But if we see TY VIX move from 6 to 8, there's no way the VIX stays at 12.
You know what, Mark? I'll bet you if you take a look, I haven't checked it in an awfully long time, but in FX, I'll bet you if you look at the euro volatility, we were just ahead of our time 3 or 4 years ago with the real vol product on euro dollar that was mired in 8 and 9 and never went anywhere for months and months. But I suspect, not having checked it in a long time, but knowing what's been going on with the euro, that volatility must be a lot different these days.
Yeah, you're right. It was unfortunate timing because euro was a product that had some movement, and for whatever reason, it just didn't get traction in the marketplace. Go ahead, Mark.
Yeah, that really was bad. Yeah, we saw the EVZ, which is the VIX of euro, got over 15, and I believe realized volatility was far eclipsing what the implied volatility marketplace was trying to price in. So that That was a pretty impressive move the last few months. Now, I understand if the bond market does start to move, you may have some impeccable timing with the next product that's rolling out, though, Don.
Yeah, we are looking forward to the ability to offer the realized volatility product on SPY and underlying of the index, and maybe it's something we'll chat about in a little while.
Yeah, we'll get to that in a second, I think, because we have a listener question. I think that dovetails into that very nicely. Of course, listeners, you can also check out my conversation I had with Bob Kraus at the last big industry conference, the Futures Industry Association. That's on our network right now to learn more about what Don and those guys have been up to since the last time they've been on. It hasn't been all just blackjack. It's been a lot of good stuff. Actually, going back to your point there, Mark, for a second, yesterday we were chatting on the option block. It was actually kind of right up your alley because we were talking about how what we're seeing out there now in the in the futures, in the Treasury futures, what they're bleeding back into from a projected Fed funds rate is about 1/3%. That's about half of what the Fed itself was forecasting back in March. So forget what the economists are saying. Real money out there is saying that the Fed is not doing anything. So I think that Jared's not here to tease right now, of course, but I think that's looking even better for your wager with him.
They've definitely moved it out to September, and I think the next move will be a move out to August, or a move out to 2016, and then Jared will be flying here and buying me the yummiest steak that I've ever had.
It will be a very delicious steak. I'm looking forward to it myself. As we move on, a lot of stuff cooking in the world of volatility right now. I want to get into a bunch of stuff, but I'm going to cheat a little bit. I'm going to move a listener question up to the Vol Review segment because it is indeed so timely. This one comes in from Mr. or Mrs. Moneypenny. I'm going to assume a lady, but you never know. He or she writes, can you please discuss the big upside VIX trade that went up this week? Was he betting on a quick market crash? A little bit of info for you guys in case you missed it this week. What we saw this week, we've been lamenting of late the just general lack of participation in the entire options market, actually. In fact, if you were down at the industry conference and if you listen to that, a lot of that audio that we have coming out of there, you're going to see a common refrain is a lot of hand-wringing over the fact that overall options volume is down about 9% so far this year. So a lot of people speculating on why that is, and we've seen some of the worst offenders of that are the traditionally institutional products like VIX, which is taking it on the chin. VIX options, we've said many times on the show, have certainly, the volume has just kind of withered and died, except for this week. We saw an enormous trade. In fact, by all measures, it was essentially the single largest VIX options trade in history. Now, that's a bit of a cheat because it's kind of a swap. It's a close and a roll. So it's kind of like a 2x volume, but still straight up overall volume in one trade, nothing has matched it. What we saw, you guys remember about a few weeks, maybe a month ago or so now, I'm trying to remember, Mark, but it was recently, we profiled someone coming in doing size 1x2s and 1x3s out there in June. Well, they came in now and essentially rolled that position. They came in earlier this week. They sold the July 17-23 1x2 call spread 180 by 360,000 times. And then they turned around and bought flip that around. They bought the June 17-23 1x2 call spread, the same size, 180,000 by 360,000. And then they turned around and sold the July 17-23 1x2 call spread. Again, same size, 180 by 360,000. Add all that together, it's a whopping 1.08 million contracts. Yes, let me say that again. 1.08 million contracts going up in this one trade. That's the ADV of that product on a smoking day. That's all total VIX volume on a day when the market is crashing. Is doing about 1.1 million contracts. And of late, it's doing about 250 a day. So that's actually 3 to 4x the ADV out there in one trade. So that's just enormous, however you like to look at it. They paid actually 11 cents net to roll this thing. So it's very interesting. We talked a little bit about the first leg before when it went up. They're essentially just extending it. So right now they're kind of just extending that bet. You know, if you look at the options alone, they're selling one, buying two. So clearly the option portion is, of course, speccing on some very, very aggressive move to the upside. Is kind of what we were saying before, Don. People are poising or positioning themselves for whatever reason for this aggressive reversion in VIX. A lot of people also perhaps were hitting new highs in the S&P. People thinking maybe the market's getting a little bit top heavy. Perhaps our friend here leaning that way as well. Of course, whenever you see this much size, there's usually another leg on somewhere, probably in the OTC vol variance market that we don't see. So we don't have all the legs on, and he probably has something else that he's trading this against. But still, just this net options position is just for the enormity of it alone is certainly worthy of discussion. Mark, I'm sure how could you miss this one? I'm sure this one caught your eye this week.
Yeah, I mean, well, the funny part firstly was that the media actually got the entirety of the trade wrong when they wrote it up. They wrote, 100 million trades at once. It wasn't really that big of a deal. It was just a call roll.
Yeah, they were talking about the notional value a lot, which that kind of struck me as odd too.
Stupid. It's silly. And, this was – I look at this trade and, I was like, yeah, it's not that exciting of a trade. It's a hedge, all right? And it's probably a hedge against, like you said, some other over-the-counter trade, some sort of variance, somebody that's got a huge long equity position. It's probably, the reason why this guy's doing this trade is probably because he is actually bearish volatility and bullish the stocks, and he's just trying to hedge himself somewhat cheaply. And if you look, the 1723 1 by 2 in July, that's somewhat at the money in terms of the future, but relative to the cash, it's $5 out of the money. I didn't see what all the big to do was, other than the fact that it was big.
Yeah, it's big. I think big is the name of the game. Yeah, I thought it was kind of weird. I think having watching this one, I think 1.1 million contracts is more impressive than 100 million of notional. But hey, to each their own. I guess the editors thought the 100 million figure was because you're right. That was every headline. 100 million goes up in 30 seconds.
It's just a back spread. It is just a back spread. It is the guy's turn. The reason why there were so many contracts is because the guy basically wanted to get long 100,000 of the 20 calls, but thought that this was a way to do it cheaper. That's basically what this represents.
And it's not a bad way to do it. He is actually doing it for a relatively paltry outlay. So if he is indeed short OTC variance somewhere, vol, and I think we all think he probably is, that this is a relatively inexpensive way to hedge that. So I take my hat off to that from a savviness perspective.
Yeah, and how much do you think? How much money do you think he's giving up 11 cents, he or she? Don, what do you think if he a variance trade that size in the over-the-counter market? All right, if he's able to hedge it off, how much money do you think that guy made against the customer?
Well, I'm sure that there was that aspect of it, but don't forget that a back spread is not the same as just looking at the 11-cent debit and saying that that's all you can lose with this particular trade. Because if he sold 17 and the upper strike is 23, then if they park this thing at 23, not saying he has to sit there and watch it to expiration, but, obviously the danger there is losing the 6 points on the short before the 2 times long kicks in. And so if he's actually short variance against this and you go from 17 to 23, that's not much of a hedge. You're losing on the back spread and you're losing on the short side also. So there could be some problems with this trade. And I used to trade the other way, of course, and collect credits and do 1 by 2s, long 1 and short the 2. But they're not easy spreads to manage either way, because when you did them from the ratio spreads the other way, you always were hoping that you'd move up, but that you'd move up slowly. And it's tough not only to dictate the direction you want in the market, but how fast you want that to happen also. So
I'd imagine he's going to delta hedge this on the way up, wouldn't you think?
I would hope so.
Yeah,
I would hope so.
Yeah,
I mean,
he's got to have a plan in
interesting
place for that 17 to 23 range, because Don's right. That is a huge black hole in the strategy.
Yeah, if it makes a quick move, the interesting piece is, if it makes a quick move, he's going to do really well because vol will pop and the upside will pop. But as time passes, he's going to flip from kind of being long underlying to short, and he'll actually have to buy futures on the way up despite having this big buy trade. And actually, if he's smart, he may actually buy some, between 17 and 19, if this thing does take off. He may actually he or she may actually buy futures in that range to hedge off and kind of isolate the 17s away from the 23 calls if this thing rallies.
Yeah, he's got to. I'd be stunned if he just sat on his hands if it was hitting around. If it's anywhere in that 17 to 23 range.
and you really.
How's that 200,000 lat backspread you got?
I'm just sitting on it.
Fine, let her run.
I'm just letting it roll.
Yeah, let her run. He'll be fine. Bigger go home.
At even money with 6 points on the width of the strikes, I guess that means you sit there and watch it. You got to be up close to 6 to 23, 29, before you're actually making any kind of money.
Right.
You dip down to 17. Now you start coming back up again. You're only touching the horizontal at 23 before you start going again. So it's not an easy trade.
That thing's got some sweet gamma right now, but as that thing decays, that's why I think he's actively rolling it when it gets to 30 days to expiration, because that way, he keeps it 60 days out. He doesn't run into problem that he's got some time to let that gamma work. That June one that he closed in about a week starts turning it into a serious nightmare if VIX rallies.
Yeah, this guy is savvy enough to not want to deal with that. The final few weeks of the contract, we said this many times on the show, not just the settlement, but all the weeks approaching that and the gamma explosion, everything else, that position like that could become very unwieldy. And this guy clearly choosing discretion to be the better part of valor. Either way, from a size-wise, if you look at it just from 1.1 million contracts, if you're some of the other outlets and you like 100 million, whatever your flavor du jour is, I think it's just interesting more from a theoretical perspective, kind of speculating on what he may have on against this, what his real intentions are, as well as, like we were just saying, how you would maybe adjust this if the futures or the vol were to maybe move against you and get into that 19 or 20 handle range, which would certainly be, I think, seeing a few beads of sweat showing up on his or her brow. So great question there. Money paid, Benny, great trade to talk about, very timely as well. We also saw some other upside trades going up this week, June 20 calls being very popular, 50,000 of those going up like that. But other than that, everything else pales in comparison to this thing. Looking at the top strikes, the hot strikes, no surprise, the number one strike, nearly 400,000 contracts. Guess what it is? It's the July 23s, because that's where all the action is. 380,000 coming in number two for the May 20s. And then the June 23s, again, surprise, surprise, 316,000 still left open on that old strike. And then down to 300,000 for the June 20s. The June 18s dropping off now to 231,000, then down to 200,000 contracts with the July 17s. Number 7, 8, and 9 are the June 17s, May 21s, and May 14 puts with about 190,000 to 185,000 contracts each. And rounding out the top 10, only one put on the list this week. That was the now rounding out. We are at May 19 calls, 182,000. A lot of contracts actually open right now. I think no small part due to our friend here with 1 million contracts going up here, about 500,000 or so of open interest that he's bringing to the table here. 7.84 million contracts outstanding, about 5.8 on the calls, 2 million on the puts. So once again, VIX getting a wee bit call heavy for those of you out there who like to follow that indicator. But moving away from VIX for a second, Don. You and I were chatting before the show. You obviously have some skin, some knowledge of the volatility products game. You've been certainly active in that space for quite a while. We've, of course, discussed on this program in your absence, Don, many of the other competitors that are entering that space. We had Scott Nations on talking about his VolX product, which was essentially VIX without the skew. We talked about that quite a bit. We also talked about one that made a lot of headlines about a year ago, then seemed to go away. And that was the proposed Whaley product. And the problem they were proposing to solve is one we constantly lament here when it comes to VXX. You know, VXX being that very, very uber popular volatility VIX-based ETF. Of course, the problem is that it runs into that Contango in the futures. And so retail people and maybe some institutional as well who like to buy and hold this thing, they get crushed, and the numbers are anywhere from about 4 to 15% a month, depending on how steep that curve is and what else is going on in the market at that time. So not a good long-term buy and hold. Yet people still try to do it, and it doesn't work. So Whaley, Robert Whaley, of course, the known far and wide as the father of VIX, decided he was going to solve that with another ETF that was going to not have that problem, not suffer from the Contango. And everyone about a year ago when the last big release came out about this said, hey, that's awesome, that's great, we'd love to see it. But then everyone said, how the heck are you going to do that? And that's when they seem to kind of go back into their shell a little bit, because with a product like that, the devil is certainly in the details. Well, fast forward a year, and the news is just coming out as we're recording this, listeners, that we probably are seeing this thing going to launch now on next week, May 19th. So by the time you hear this, listeners, that product will finally perhaps be hitting the market. It's coming out of AccuShares. It's going to be their new volatility ETF. They're going to float two different ones. The spot VIX up class was going to track VIX over a 1 month period, and the AccuShares spot VIX down class, ticker symbol VXUP, VXDN, is going to seek to track the inverse performance of the VIX over a 1 month period. Don, I know you've been paying close attention to these and all the things going on. Give us your take on these, as well as some of the interesting, perhaps, compromises they had to make this essentially Contango-less VIX ETF come to fruition.
Well, I can tell you that upon studying it, I looked at it and I said that there's something wrong here. It's too good to be true. This can't really be as it's being represented. And my first thought was, if you really were capable of having a product that was going to offer you spot, everybody knows that unlike the stock market, volatility is a mean reverting instrument. So when volatility spikes up, when there's a meltdown in the market or wherever, and you see levels of real or implied volatility, 40, 50, 60, 80, 90, whatever, that cannot and does not persist, and it doesn't take very long for volatility to revert to its mean. If you're up at 80 and you're trading a futures contract, you're not going to be able to sell 80. Everybody knows that, because everybody trading those futures is going to look forward and say that we're not going to be at 80 a month from now, and so you don't get the opportunity to sell that spot. Likewise, if you've got extremely low levels, historically low levels, maybe single digit, and you want to try to buy 9 volatility implied, you're not going to be able to do that either with futures contracts, because not only the contango, but the reversion to the mean, you're going to look out a couple of months and you're going to have to pay anywhere from 12, 13 or so for those futures contracts. Now, if you tell me you're going to offer me a product where I can sell 90 and buy 9, I say that just isn't going to happen. There's something that we're missing, and I'll tell you what it is in just a moment, because everybody in the world and every one of our listeners, and they wouldn't wait for 90, I'm sure most would be happy with 30, would sell historically high levels, knowing that there's no discount to that because it's not a futures contract. And they would buy historically low levels, knowing there's no markup because it's not a futures contract. What you see is what you get, and they're representing that you get the spot, that you get the cash. So it doesn't make any sense, and I don't know how it could be viable. And I started to look around a little bit, and I found the following. The fund will not hold any securities of any kind. The fund will hold only cash and cash equivalents, T-bills, what have you. And then you come to this very telling last sentence. Each fund, because there's an up fund and a down fund for VIX volatility, will issue its shares in offsetting pairs, where one constituent of the pair is positively linked to the fund's underlying index, and the other is negatively linked to the fund's underlying index. Now, here it comes. Wait for it. Therefore, the fund will only issue, distribute, maintain, and redeem equal quantities of up and down shares at all times.
Yeah, that I think that we always said the devil is going to be in the detail of this product, and that clearly that is where the devil is raising his ugly head, because you're right. In a product like this, you're going to want it in times when the market is really rocking and rolling. And how many, VIX is shooting off a cliff? How many people are you going to get out there aggressively selling vol? You're going to have 5 trades. You're going to be able to match up on any given day. This sounds like a solution that doesn't really maybe perhaps meet the marketplace.
But Mark, there probably is some utility to this, but I spent a lot of time thinking about it, and my thought is it's going to trade. Have you seen how people will calculate kind of a constant 30-day VIX future? You know what I'm talking about, where they'll use a blend of, for instance, today they use a small amount of May and look at a lot of June, and then when May rolls off, they look at kind of a pairing of June and July. My thought was that this might trade kind of like some sort of – it's not going to trade like spot, plain and simple. But it may trade like some sort of spot VIX future that has kind of a constant duration, as opposed to the way the futures actually have this rolling off of in Contango. So that would be a scenario where maybe I think it could trade. So basically, when vol's really low, it's trading at a premium, similar to how a VIX future would trade. And then when vol's trading really high, it's trading at a discount, but maybe it's not having that roll-off effect.
They're going to have a terrible problem, Mark. Look, I'm not with the SEC, but there's a very scathing dissenting opinion. This was approved. It's going to trade. But there was a dissenting voice from one of the commissioners. And you can read it on the internet. And the dissenting opinion said basically that she doubts very much that it's going to trade and track spot, and that people should be very leery, despite what they're representing, that it's going to do.
It's not going to track spot. It is not.
But you got to read the specs to see that that's the way they're advertising it. That they're advertising, there's a contango problem, and all the previous ETFs have had this constant decay, and we've solved that, and now this is going to trade and look like spot VIX and not have all the problems that either futures or ETFs based on the futures have had in the past. And, again, when you say you're going to do pairs like this and the market crashes and VIX spikes up to 70 and you've got 100 people wanting to sell for one who would buy at that level, I imagine what they're going to say to 99 people is, go away, you can't trade. and that's very strange. I know a little bit about gaming and sports wagering and what have you. You go up to the window and bet on a football game, you don't need a paired trade to bring a friend with you who wants the other side. The sports book stands ready to book your action, and if they have an imbalance, well, that's some of the risks of being in that kind of business. They try to put up good numbers and balance as much as they can and take the VIG, the 10%, which is, laying 110 to win 100, but it doesn't always work. And they aren't always able to balance. And that's what they accept, that sometimes they get beaten on a game because of the imbalance. Well, this fund is saying, we're not going to be in that business. Okay?
That's not gonna work.
We're not going to book any imbalances.
Yeah, what'll happen is the imbalance, it'll be kind of like, they're going to need to do kind of like a TAS thing where, that's what I'm saying. It's not going to track spot, but I could see it acting kind of like a VXX that doesn't have a decay to it more than a VIX. So they shouldn't be representing a spot VIX. What they should be representing is a potentially tradable, a tradable volatility-based contract that theoretically does not have the same roll yield decay issues as a VXX, but it is going to act very similar to a 30-day VIX future. That is my bet on how this thing trades.
So
if it trades, because there'll be enough when vol gets oversold. What will happen is there'll be more buyers and sellers, and until they get that equilibrium, all right. So when VIX is at 9, it's going to be trading 14, just like a future.
Well, you know what, Mark? I have no stake in this either way, but I'm just reading from their website.
I'm with you, Don.
I understand. I understand why this commissioner dissented, because this is called the AccuShares Spot CBOE VIX Fund.
Yeah,
Spot fund will seek to track the spot price of the CBOE Volatility Index, commonly known as VIX.
Not a chance. It is not going to track spot VIX. I can promise you that much.
Don, I think your odds makers example is a good one, because in that scenario, if you're coming in and everyone's lining up and everyone's, betting on, let's say, the Mayweather-Pacquiao, everyone's betting on Mayweather, they have the ability to adjust their odds to keep things in line. These guys don't have that, because ostensibly, like you said, they're trying to deliver spot VIX. They can't adjust that. They can't bid it up to make those things line up if everyone suddenly is lining up to buy VIX, which I think goes back to Mark's point that this product probably will not deliver the exact spot VIX because of all the issues we're discussing. I'd love to bring Whaley on to kind of get his viewpoint on it. But while you guys were talking, I was going through some of the prospectus of this product, and I came across this, which is kind of interesting and kind of a little bit disturbing to me. Ostensibly, the entire reason that this product exists is what I mentioned before, which is there's this lot of hand-wringing, a lot of concern over VXX and getting impacted by Contango. Their whole reason for this product being created was to insulate the retail audience who want to come in and buy and hold this product from getting crushed by Contango. Yet, if you read, he says himself, this is for short-term trading bets. They say in their prospectus, investors who do not intend to actively manage and monitor their fund investments at least as frequently as each distribution date should not buy shares of the fund. And he said in several other interviews, this is only for short-term bets. So they created a product for buy and hold investors that essentially is supposed to be insulated from Contango. And then they say, you shouldn't buy and hold it. So then I'm kind of left wondering what the reason for the product is. Do we need another short-term VIX speculation product? Because we already have that. VXX works, VIX Options works, VIX Futures work. It's just odd. I don't want to beat up on it too much because it's an interesting idea, and I kind of wish it would work. I shouldn't generalize. It's not fair. And I know Robert Whaley is a highly respected academic, but we've had those discussions before. Academics historically have not necessarily made the best traders or developers of funds, and some of our listeners may be familiar with the name Myron Scholes. And
a few years back, he was associated with long-term capital management, and we know how that turned out.
No, assets are mean reverting, Don. I don't know if you know that. You have to just wait about 10 years, and it works out pretty well.
So we shall see.
I'm with you, Don. I don't know how well this is going to do. But it'll be very interesting to see how this thing operates. I don't know.
Yeah, this was an interesting one. I really think it was launched with a good intention to try to solve this problem. I think they've discovered since, as they're trying to actually make this product deliver what they said, that they had to make some compromises, including the fact that you can't buy and hold it, that may indeed detract from that initial value proposition they were bringing to the table. Again, I kind of hope this thing works out. We do like to see more players in the vol space, just to have selfishly more to talk about here on the show and more for you guys out there to trade. But it just doesn't seem like it seems like what they've actually launched is very, very different from what they proposed about a year ago. Again, I want to bring those guys on. Maybe we can see if we can get some clarification on some of this stuff. But there is a lot that still needs to be determined about this product. Again, launching May 19th. So if you're interested, go check it out and let us. If you guys are thinking about this one, you want to trade it, you have some of your own questions or thoughts on the product, let us know. We love to hear from you. Speaking of hearing from you guys, we got to wrap it up soon, Don, because I know you got to go. But really quickly, there's a couple. We had one listener mail. I want to get one more here if we can, really quickly. So let's dive right on into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, welcome to the volatility voicemail. Got to keep rolling, so let's get right into it. This question comes from Andrew G. Don, one of the reasons I wanted to have you on the show this week is because we had a question that was right up your alley. In fact, that you guys are even invoked in it. Andrew asks, are there any packaged products out there that will replicate a long or short delta neutral straddle position? The key part, I believe, would be the adjustments, as a product would require multiple adjustments to remain delta neutral. I've listened to your program for a long time and come to the conclusion that delta neutral is the best way to capture volatility in the marketplace right now. But I don't want to tie up all of my capital and all of my time managing and adjusting one trade. I prefer to buy or sell something that handled the lion's share of the work for me. If there was some slippage on the execution, I could live with it as the ultimate cost of using a packaged product versus doing it myself. Thoughts? Am I crazy? I'd love to get the old VolX guy's opinion on this as well, if possible, since I'd assume they'd have insight into this issue. A great question, Andrew G. This has kind of been one of our main theses of this show, really, is this discussion of how do you capture real volatility in the marketplace. This goes back to our very first episode. We talked about delta neutral and slippage and the pros and cons of that strategy is kind of being the way it's been done forever. Your point about the adjustments, I think, is key, because you can go out and buy OTC vol products right now. They're packaged for you. The adjustments are where it becomes interesting, whether they can do the adjustments for you, if they're managing the position for you and doing adjustments, and it's kind of like they're managing your money. It's kind of a weird beast. But Don, I'd imagine you might have some insight into this for our listener. And since you were invoked in the question itself, I will give you pride of place. What do you have to say here for our friend, Mr. Andrew G.?
Yeah, I was invoked as the old VolX guy. I want to know clarification.
I was hoping you would miss that part.
I want to know if that's the former VolX guy.
I think that's what he meant.
Guy at VolX.
I don't think he meant aged. I think he meant former.
Okay, well, we'll give him the benefit of the doubt. Last time when Bob Kraus was on the show, I think he spoke about the impending or the hopefully upcoming SEC approval of our real vol options that are going to be listed on the Boston Options Exchange box. And I think that since that show was done, the approval, in fact, came through on May the 6th, if I'm not mistaken. So we are now cleared by the SEC to offer options that will settle to 21-day realized volatility of SPY, basically the S&P ETF, the SPDR. And that would certainly be an extremely effective way to capture volatility without having to delta neutral hedge an options straddle on a daily basis, where you do run into bid offer spreads, rebalancing, directional problems if you start to stray away from the strike price, losing the optionality that's involved. Trying to capture realized volatility by trading a delta neutral straddle can work if you basically don't stray too much from the strike and you don't have too many follow-ups. But ironically, if that's the case, it kind of means that you're not having a lot of volatility. So if you bought that straddle in the first place in order to profit from volatility, saying that it will capture the underlying realized volatility, but that there isn't much of it, isn't so encouraging in any event. But doing it with a futures product that would settle to realized volatility, and we are in negotiations with a couple of the major exchanges to actually list the futures as well as the options that will trade on VOX, is a very efficient way to do exactly that, capture volatility, but with a single trade. So whether you would buy a futures contract at a particular level, or you would do it through what we call a synthetic futures or an options combination, if you want to be long, take an at-the-money call and buy it, sell the same at-the-money put, and you have replicated the payout of a futures contract, what we call synthetically, or by doing a combo. All that remains right now is to say when these will be launched and will be actually up and running, and we're kind of debating back and forth about this simply because we do have the ability to launch the options rather quickly, but if the futures as a counterpart are not forthcoming immediately, there's a managerial decision to be made whether it would be advantageous to wait and to have the futures and the options complement each other and perhaps enhance trading and enhance volume. And we've also got the summer coming up, and doing a launch right before, July and August may not be the most favorable thing as well. So it's a decision we need to make and will be making very shortly, but there is the possibility also of waiting until the fall, until after Labor Day, and launching in September. In any event, those products will be out there. It's only a matter of a short time, and that would be a rather effective way to capture the volatility that our writer is inquiring about.
Yeah, I wish I could give Mr. Andrew G. here a whole litany of solutions to his problem, but I've been scratching my head about the adjustments is where it all falls apart. I don't know anything that's going to deliver the adjustments for you, which is kind of the entirety of what you guys are talking about over there, Don. Your product, the whole reason it exists is it kind of obviates the need for the adjustments. You just get that realized vol and it's delivered to you, and you don't need to sell futures here and buy futures here and delta adjust. So if that's kind of what he's looking for, I think you guys are really, at this point, you're not launched yet, but when you are launched, you'll kind of be the only game in town, unless there's some obscure OTC structured product that claims to represent this and that will do the adjustments for you and deliver you that net volatility. I have yet to see that, but it could exist. But that's kind of about it for in terms of solutions for you, Mr. Anjum. We are kind of running up against this. So let's dive into a really quick crystal ball before we wrap up.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, you guys know the drill. This is the portion of the show where we prognosticate wildly and indeed recklessly into the future of volatility. And Don, since it's been so long since you had a chance to do this, hopefully it won't be 2 years since you get to do it again. Give us your wild and reckless prognostication on the week to come from a vol perspective.
I'm going to say the same thing that I said when I was on the show. My feeling about volatility is that it rarely has a mind of its own, and we know very well the negative correlation, at least between implied volatility and the market itself. And so, to me, forecasting volatility has a great deal to do, at least when you're talking about implied, perhaps a little less so for realized, where the correlation is not at all the same. Trying to forecast where implied volatility will go is very much like saying, let me forecast what the market is going to do for the next week, and then I'll say volatility is going to go in the other direction. We just made another high on the S&P yesterday, a little bit off today, but basically an all-time high in the S&P. So, it's really difficult to say that that's going to keep going without any kind of a little retracement or drawback, but not having any crystal ball for 1 week at a time. I would simply say in general to listeners that if you are trading VIX products and if you're trying to forecast where implied volatility is going to go, don't disassociate that from your market viewpoint, because with an 80% negative correlation, trying to forecast where the market is going to go certainly is a tremendous adjunct in trying to forecast where implied volatility is going to go.
And Don, really quickly, I know you have to run, but if our listeners are interested in all what you were just talking about and all the stuff you have cooking up at VolX, where should they go?
I think that they'll find the website has really been revamped and enhanced, and there's a tremendous amount of information about volatility in general. There's an extensive library. There are tremendous interactive charts where you can plot realized volatility, vol, look at it with respect to the underlying, see that correlation that I was just talking about. So the website is VolX, VOLX.US, volx.us. Have a look around. I think you'll enjoy.
Well, Don, I'm glad we can get you back on. Hopefully it won't be another 2 years before we get you back on the Vol Views program. And we look forward to seeing these real vol products getting into the marketplace and mixing it up.
Well, thanks very much for the opportunity. It was like old times to both Mark Sebastian and Mark Longo. Always a pleasure, and hope to be speaking with you again soon.
Great. Take care.
Bye-bye.
All right. And Mr. Sebastian, what's your wild prognostication for the week to come, sir?
Yeah, I think bonds are going to have a nice rally here for the next week, and I think that we could see now that if the market manages to stay up here today, I think we could really be set for a run higher and more of Don's low volatility.
So you're saying sold to you is what you're effectively saying.
I am saying vol sold to you, stocks buy them.
All right, and as we're wrapping up here, I know you guys are cooking up a lot of cool things over there in the land of the pit. What can our listeners look forward to coming down the pike from you guys?
We're doing a free webinar on creating income with options. You can go to www.optionpit.com/creating income to register. It's going to be May 20th at 8 p.m. Eastern Time.
You started saying the HTTP, didn't you? You flashed back to like 1996.
I know, I did. Like everybody doesn't know that already.
HTTP://www. Good stuff. Well, listeners, surf on over to optionpit.com to learn more. And, of course, visit the folks over there at VolX. Haven't plugged volx.us on the show in a long time. It feels good to do just that. And that real vol stuff they have is indeed coming to fruition. They have SEC approval now, like Don said. It's just a matter of sorting out the future, the underlying, and then they'll pretty much be off to the races. And we also will stay glued to this Whaley product, see how it performs. Hopefully we'll have a little bit more data on next week's show. And on behalf of Don and Mark, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, for sending in such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4222. VOL, or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.